Good afternoon, everyone, and thank you for joining us for But What Does It All Mean? This is a new series that the GCP Division on Equity Inclusion is launching to help bring some of both national and local research to our region and spend some time with the researchers and authors about what does that mean? What does it mean for us? And how will we move forward and take actions because of the research? Today, I'm delighted to have with us Dr. Henry McKoy Jr. Henry is joining us from Harvard University's Kennedy School of Government, where he's a visiting Municipal Fellow at the Ash Center. We're going to talk today about the research that he and his partner, LaShawn Banks, put together on Cities Economic Equity Index. As you saw from the information when you registered, this economic index ranked Cleveland 19 out of 21 cities in relationship to equity. So I'm going to turn it over to Henry. He's going to walk through the presentation. I do want a minute to mention a few things. We want to make sure today's presentation is extremely valuable to you. So we ask that you submit questions by clicking on the question button in the control panel and typing your question in. Both I and my colleague are monitoring that. Henry's going to talk first about some national data for about 10 minutes in this presentation, and then I'll ask a few prepared questions around that national data, and then he's going to get into the local data for Cleveland for another 10 minutes, and then we will open it up to questions. So we hope to have a full 40 to 45 minutes of give and take with the audience. So thank you all for participating. Henry, welcome to Cleveland again. You joined us as part of the Forward Cities cohort from Durham, and you should know that our region adopted the Racial Equity Institute work here because of that Forward Cities visit. And because of that visit, I think we are now up to over 4,000 individuals and leaders in our community who have gone through the Racial Equity Awareness Institute training. So we are very proud to be a partner with you, and I was delighted to get your information and get in touch with you and LaShawn so that we could bring you to Cleveland and help explain to us what does it all mean. I'll turn it over to you. Thank you.
Well, thank you. Appreciate it, Brian and the team. Everyone who's welcomed me to this conversation. I appreciate all the folks that are joining us via this webinar. I think it's a great opportunity and a great chance to talk about really what does it mean, looking at this idea of Cleveland and entrepreneurial disparities. Just before I get started, I just want to share with you all LaShawn Banks, who's my kind of co-conspirator in this work at Harvard. She sends her regards. She's actually on maternity leave. She's has a new son, about 3 weeks old, and so she couldn't make it today. But I'm here representing both of us, and thank you, Brian and team, for all you do. And so I want to jump into the presentation and give some sense of what to expect as we kind of move through the presentation. So let's see if I can advance my slide. Let's see. There we go. All right. So as Brian said, I'm going to get into some details that will talk a bit about what's going on in Cleveland and the entrepreneurial disparities and really what does that mean. I'm gonna tell you up front that this is quite a bit of information to digest. I think Brian has shared some of the reports that we put out, at least that gives you some data sets, and certainly feel free as we go into the question and answer portion to kind of ask some clarifying questions. And again, these reports are available, but it's going to be in some ways like drinking out of a fire hose. But I want to take a couple minutes to start out with giving some COVID-19 context. We really can't talk about this without recognizing where we are right now. Then as Brian mentioned, I'm talking a little bit about the economic inequity of America. Then we can go to kind of a Q&A for a few minutes. Then I want to give you a bit about the background of the report and ranking that Brian mentioned that I think he did share with some of you. And then also look at the specifically at the numbers of the economic inequity in Cleveland, the parity, disparity, however you want to frame it. Then do some contextual wrap up. and then let's talk about a few takeaways for Cleveland, and then we'll open up for this kind of extended Q&A aspect. And so we'll work through that. So I want to start out with this kind of framework that we've heard a lot of times over time, which is, when whites get a cold, blacks get the flu, they get pneumonia, things of that nature. And so, that context really just talks about this idea that when economic hardships hit the white community, broadly speaking, that they end up doing tremendous more damage to minority communities, particularly African American communities. And so I think in that context, the question becomes, what happens to blacks and Hispanics whenever whites get the coronavirus? Where does that lead the community and things of that nature? So I want to use that as a wraparound context, because certainly the data that I'm going to show you now is going to be pre-COVID-19, but it's certainly important to recognize that though we're seeing on the news a lot about all the disparities and issues that we have, we know that these issues and disparities have been there the entire time. Now they're being exacerbated in some ways and accelerated, but they've always been there. So I leave that as a contextual aspect that we'll come back to at the end. So again, I'm about to show you some pre-COVID data for America, and my work is focused particularly around this idea of entrepreneurial inequity. And so the way I contextualize that is I look at outcomes, and we look at things, whether it be educational outcomes or health outcomes, community outcomes, however you want to frame it. So economic, social, and my particular lens is through this idea that those outcomes are driven by certain gaps in wealth and things of that nature. And then I hone in particularly on my belief, the relationship between the entrepreneurial inequity and the upper level inequities. And so, a lot of my focus is really on this idea of what do we understand, what does it all mean as it relates to the different discrepancies in entrepreneurship amongst different populations, different communities. And so with that, I will move into some of this data. So from a U.S. standpoint, so I want to, again, start out at a high level. This is what I call the American Entrepreneurial Equity Curve. And so to give some quick framework around that, if you look on this screen, if you look at the flat line, the green line would essentially be equity. So we have this broken up into the 5 major racial groups in the United States. You have whites, blacks, American Indians, Asian Americans, Hispanics. And so this is a relative index. And what a relative index simply means is that all of these points on this graph are in relation to each other. And so, for example, when one point moves, somebody else by default has to move. So if whites go up, somebody else has to go down. If whites go down, somebody else has to go up. Black goes down, et cetera, et cetera. And so it's a relative index that I created. The points of the index go from -1 to +1, and 0 again being total equity. And I'm gonna talk more about this as we go through the deck, but essentially I'm looking at a few different data points. I'm looking at a community, in this case, America's population share, each of these racial groups, what is their share of the overall population? I look at the total number of businesses and the size of those businesses that each of those populations have as related to the American economy. I look at the firm share, so how much revenue does each of these firms through racial lens, how much do they capture of the overall revenue? And then the poverty share, what is the overall community's poverty share as it relates to that community? And so I take those numbers, I throw them into a little mixer and come out with this index. And again, when we get to Cleveland, I will show you that in more fine numbers. But I mention that because the red line is actually what the entrepreneurial equity curve looks like in the United States. Again, the flat line would be if every population had their share of the number of firms, the size of firms, the total number of revenue, and the poverty, it would be a total flat line. But we see on this graph that whites are well above the equity line, blacks are well below. American Indians tend to be right on the line. Asian Americans tend to be slightly above the line, and Hispanics tend to be below the line as well. So this is visually what entrepreneurial inequity in America actually looks like right now, and what we're up against. So this slide, in order to kind of, move it into some kind of, analogous conversation, so that, if I was having a a real person-to-person conversation. How would I talk about this in very kind of real terms? So I start out with this. I call this slide "Road to Zero Wealth" for Black and Brown communities in America, and that actually comes from, there's a report that's out called "Road to Zero Wealth" that was released on September 11, 2017 by a think tank out of DC. And essentially what it talked about is this idea or the trend of African Americans and Hispanics moving towards zero wealth in the United States. Essentially what it says is that by the year 2053, African Americans will have a median wealth of zero. And what median wealth simply means is that half of the African American population will have a wealth above zero, the other half will have wealth below zero. And so that's expected to hit, based on current trends, again, pre-COVID-19 trends, to happen in 2053. In terms of Hispanics, that kind of point of intersection of zero wealth is expected to happen 20 years after that for Blacks in 2073. So Black and Brown communities, particularly African Americans and Hispanics, are on a road to zero wealth. I put the 2044 up there because most of us know the demographic trends have America becoming a majority minority community right around the year 2044. And so I frame that to say that you know, if the majority of our country has a zero or negative wealth, you know, in the future, then that's not just a problem for that community, it's a problem for everybody. And so I want to kind of from, again, an analysis standpoint, imagine America in a very simple way, right? So this is kind of a snapshot of America. Imagine America had these kind of 4 components. So imagine America was 100 people. Imagine in America there were only 100 companies. Imagine in America there was only $100 in cash. And then the fourth kind of column over there, the fifth column, depending on how you count, entrepreneurial capital leverage. Imagine there was only $100 worth of additional capital, philanthropic, public sector capital, private sector capital, you know, venture capital, all these kind of things in the overall economy. So think about America in those 4 different categories: 100 people, 100 companies, $100 in cash, and $100 worth of additional leverage. And then let's look at that from a racial standpoint. America, based on its current demographic, would be 66 white people. It'd be 13 Blacks, 1 American Indian, 5 Asian Americans, and 17 Hispanics. If you end up doing the math and it comes a little off, you know, it's not that I can't add, but Hispanics tend to, you know, can fall into any race. And so sometimes the numbers are a little bit off, but that's essentially what our demographic looks like. Well, those 66 whites in America out of the 100 would own 83 of the 100 companies. And of the $100 worth of cash that the revenue generated from those companies, those 66 whites would share $89. I'll come back to that last column in a moment. Imagine this again. Imagine there's 13 African Americans. Those 13 African Americans in the United States would share only 2 companies amongst them. And of all the revenue from those companies, those 13 people would have to share $1.22 out of that $100. And so you see kind of how it's stacking up. Asian Americans tend to be right again at parity. They would have five of the people would have actually 9 companies, and they would share $5.68. Hispanics, like African Americans, are in the deficit in terms of 17 people would share 6 companies and $3.85 amongst them. And so again, just imagine that, you know, you're in a room with 100 people, and this is how the money and the ownership is being split up. That final column, the 100 entrepreneurial capital leverage, again, that's identifying all the capital markets and things that happen in the United States and where money comes from, the public sector, private sector, philanthropic sector. You see that actually whites and Asian Americans are the only 2 that really get sufficient access to that capital. Whites with 92 of the $100, Asians with the other 8. And the other populations, African Americans, American Indians, and Hispanics at the aggregate actually are in the deficit, which means that they, in some ways, we pay into a system and the resources don't come back out. And so we talk about that a little bit later when we get down to the local level. You know, what does that look like? You pay into a system and it's not coming back out to you. And so this is a snapshot of what, you know, America as a whole looks like. And so from that standpoint, you know, as we move to this kind of Q&A piece, I want to quickly talk about this. So in order to understand why it looks the way it does at the aggregate level, from a business standpoint, we have to understand what it looks like at an industry standpoint. So grabbing the data from a few different industries, construction, manufacturing, wholesale trade, et cetera, and understanding kind of who controls those markets and who has ownership in those markets. And every city, so Cleveland and whoever else could have the same demographic for their own city. This is at the United States level. And so this particular slide is only for firms that have paid employees. So it doesn't take into account individual sole proprietorships, and we'll talk more about that again a bit later. But the key thing I want to capture on this slide is that green means good, red means bad, blue is kind of neutral in some ways. So if you see that from again a share standpoint, in a perfectly equitable world, the 65.59% whites in America would have 69.9% of the firms. They have 65.59% of the construction firms, and so on and so forth. Same thing with blacks and American Indians, Asians, Hispanics. The deficit that you see, so for example, though blacks make up nearly 13% of the population, we only have 2% of the firms that actually have employees, 1% of the construction firms, 0.5% of the manufacturing. And the reason the distinction actually matters, particularly around employer firms, is because of the total GDP. Firms that have employees capture 97% of that GDP. So in a $34 trillion economy, the firms that have employees would capture about $33 trillion of that. And so that's why there's a connection between firms that have employees, paid employees, and wealth creation. And so this is just kind of a snapshot from an industry standpoint on a national level why it looked the way it did on that last slide. And the final slide before we go to kind of this quick 5-minute Q&A is that an additional aspect of that, as you saw the discrepancies on the last slide, is that there is a national loss of particularly black employee firms. So this data was looked at essentially around the time of the last recession, which again will come into play a little bit later since we're dealing with a serious crisis right now. So this data actually gives us a whole lot of insight into kind of where we are from a standpoint. So let me help you understand what this slide actually says, since I know it's a little bit noisy. So the reference groups is the white firms, and so that's why you don't see white firms on here. These are comparisons to white firms, kind of with white firms being the reference group. So, and the reason I put this up here is because I want you to understand how data can be tricky depending on how you look at the data. And so in this category, a lot of times with data with firm ownership, there's 3 different categories of firms. There's all firms, which means these are all the firms that are in existence, whether they have paid employees or they're sole proprietorships. And so it's kind of a catch-all. The second category, firms without paid employees, that's simply sole proprietorships. There's more sole proprietorships than there are firms with paid employees. That's just because a lot of people, they do gig economy work, they start small businesses, they become consultants, and so that's a natural thing across all populations. There are more firms with no paid employees than there are with paid employees. Then the third category is firms with paid employees, and I just told you a few minutes ago why that's so important, because those are the firms that actually capture the most revenue in any economy, and those are the ones that create wealth. And so the yellow highlighted here, I'll give you kind of a quick understanding of what that means. If I look at the data that says, all firms, and I'm comparing these racial groups to the white population, what this says is that for blacks, that 62%, it says that in order to be equitable, blacks are 62% of the way towards whites. So there's still a 38% gap in terms of where black entrepreneurial firms are to be equitable compared to whites with all firms. And with Hispanics, Hispanics are only 50% of the way towards equity compared to whites. Interesting enough, American Indians and Asians are both overrepresented against whites as it relates to that. And that column right beside it, you will see that if you just looked at the data, it looks like, wow, African Americans made up about almost 34% of the way towards being equitable toward whites. Hispanics made up almost 31% toward being equitable towards whites. Those must be great things. But if I move over to the next column and I see firms without paid employees, what that essentially says is that, okay, when you de-aggregate the number and you say, well, hey, these are just the firms without paid employees, actually both blacks and Hispanics do a little bit better compared to whites, right? So blacks are 72% of the way equitable towards white firms, and Hispanics are 64% of the way toward equitable firms. And so it shows you, okay, wow, that's a great thing. Well, if I go to that last column that has the green box around it, this is where, kind of rubber meets the road. In terms of looking at black firms, when compared to white firms, black firms they have only 13% of the firms they should have when trying to be equitable to white firms. And so you see that gap is a much bigger gap in looking at that. Hispanics only 25% of the way toward equity as it relates to white firms. You see Asian Americans actually overrepresented against white firms, and American Indians are below. But in this last data set, what really stands out is the fact that African-American firms were the only firms that actually lost ground in terms of firms with paid employees compared to the previous measurement to white firms. And so what that means is that African-American owned firms that have paid employees are either going out of business, they're being sold to majority companies like Shea Moisture was sold to Unilever, which are great for exits for them, but it takes these companies out of the ecosystem. And so this gives you kind of a quick snapshot of what it looks like on the ground at a national level, which will help build some context for the local level. So Brian, I turn it back over to you for a few minutes.
Thanks, Henry. That's fascinating information. Again, even though we did a prep session, I learned something each time I look at it. A couple of questions that I want to just throw out before we go into the Cleveland data. Just the idea that racial equity is in the lexicon of our country today, I think is significant. I mentioned the REI Institute and the awareness that we've tried to create here in Cleveland. I'm wondering if you could comment about, from a national perspective, as you prepare this research, share this research, talk to cities, announce that you're doing an index of equity, what is the reaction to you? How do people take that?
So interesting enough, thanks for the question, Brian. So, LaShawn and I do a lot of this work around the country, and I've been doing it for years. And so really what ended up leading to the idea of creating an equitable or index was the fact that I would go to these different cities and we're kind of in this, I say this high tide of diversity and inclusion. Anybody who's been around this work long enough recognizes that we go through these kind of hills and valleys where everybody's interested in it, and nobody seems to be interested, and then people come back around. And so we certainly in the last several years have been kind of going toward that high tide around people being really interested in this equity aspect. And so what I was finding when I went to these cities was that every single city was saying, hey, we're doing all this great work in equity. There's no better city than us in doing this work. We're doing this and we're doing that. And so it started raising questions to me. Well, okay, well, how do you know, kind of how equitable your community is in terms of, how do you know whether the work that you're doing is going well? How do you know, compared to other folks, where you stand? And so that actually led to the creation of the index, which actually I created several years ago. And it gave a better sense of helping these cities understand where they are, kind of where they start at, and kind of, what do they need to get to? And certainly when you start talking about rankings and things like that, it gives a certain competitive aspect to it. So that just to answer your question kind of from a more direct standpoint, I think that part of my job, at least, is to hold up a mirror to a community when I go to it and say, well, hey, just look at this. You think you're all fantastic and great, and you telling me about all these things you're doing, but let me just hold up a mirror and let you look at this and see where you are, and let that digest. And so what generally is the response is that it's very sobering to these cities and to the city leadership, because the data is the data, and you can kind of say what you want in a political speech, you can kind of twist things around, but this is just data in a certain manner. So a lot of cities, it sobers them up and kind of gets them to the point where they say, wow, now that we see this, what can we be doing?
Thanks. And questions are pouring in. We are going to have a robust question and answer session. I just want to ask you one more question on the national data. As you describe and illuminate this national problem, as you said, especially during this potential high tide period for diversity and inclusion, are there any national ideas, trends, initiatives, or strategies which you've seen demonstrate an ability to close the racial gap?
So I say this kind of as quickly as I can for such a, I mean, that's a very thoughtful and intense question. But, what I try to do is I try to be both, as I say, truthful, sobering, but also hopeful in a sense. And so certainly, waking up every day, you want to make a dent in this work in a real way. But the truth is that things are tough all over. I mean, there may be places that may have a bit better this or a bit better that, but as you saw the curve, for the most part, Black and brown folks are catching it economically kind of everywhere you go. And again, the index that we're going to talk about in a few minutes, or the rankings we're going to talk about in a few minutes, will show you some relative aspects of how maybe some places are finding a level equity better than other places, but they all are, they're all in negative territory. To answer your question about strategies and things like that, I say there's a few strategies that are popping up, but they're still very young and they're really still very scattered. One of the things that took me to Harvard was that they had an interest in me helping think about creating this kind of network of cities across the country that are focused on equity and inclusion, and even looking at it globally and figuring out, well, how do you actually do this work and do it right? So I say, I've done some work in places like Sacramento, who's they've actually passed a pretty massive bond. Again, this is before COVID-19. The mayor had come and said he was interested in doing a $400 million bond to address inequities in Sacramento, which I thought was incredible. And the city council ended up landing on about $250 million. But they're doing some pretty innovative stuff. I mean, I think, you can go to any city. I think Atlanta and Mayor Bottoms down there doing a few interesting things. And so I think from a standpoint, there's some places that we could point to that they're doing with education and the entrepreneurial pipeline and access to capital, and kind of placing space and things of that nature, and removing barriers that I think we could point to. But again, they're still kind of piecemeal, and I can't point to one place on the aggregate that I can say that place is doing it all right, and therefore I'm seeing these gaps close in any significant way.
Thanks. I know that was a tough question to answer in just a short time, but I do appreciate the specific hard examples of some things that are being done. I think we've already got 7 or 8 questions in the chat area, so I'm going to let you jump into the Cleveland data and portion of this, and then we're going to open it up and go through the questions. I do want to mention too, since I'm reading the questions as Dr. McKoy was speaking, that if you've asked 2 questions and we have a number of questions, we probably will select one of those questions versus both. And maybe we can try to follow up after this session on any additional questions. But with that, I'm going to turn it back over to you. My contractors decided to start working just as we started this webinar, so I'm going to stay on mute.
Sounds good. Somebody look to keep the economy going. So I'm gonna try to kind of move through this next part quickly so we can get to some Q&A. So I mentioned kind of going from this kind of national level. And as I mentioned, I go around the country, I see this work, and it led me to say, well, look, how do we better measure this? And so there's a program at Harvard called a Project for Municipal Innovation that I'm a part of, and LaShonda coordinates that work. And so essentially, that Project for Municipal Innovation pulls together 45 of the largest cities in the United States, and it works with the chief of staffs and the mayors and folks like that on things that they find to be important. Cleveland is actually a part of that work. And so this actual report that LaShonda and I released back in November 2019 on inclusive economic development grew out of a very specific convening that we had in October of 2019. And so I want to put that into some context. Of the 45 or so cities that we work with in PMI, 21 cities showed up for this particular event. And so, we did some workshops, we did some things of that nature. Cleveland was there. And once it was done, I said, well, okay, well, let me do an analysis of these 21 cities. And so the ranking that you will see that will follow here about Cleveland that Brian has mentioned that you all have seen, that is all relative to these 21 cities that was at this particular event. And so I don't want it to be kind of contextualized that this means that, the #1 city in this particular ranking is the #1 city in the United States. Again, this is only for the cities that was at that convening. And so the 21 cities, we looked at them, we did the numerical aspect, and we put out a report both at the aggregate level as well as the individual city level. So both of those reports are available. Brian can share them with you, we can share them with you. But I look at this work through entrepreneurship, again, looking at it via the entrepreneurial ecosystem. And so the data you're about to see right now is actually pre-COVID-19 data from Cleveland. And again, it's going to be kind of like drinking out of a fire hose, but I think you'll catch the picture. So, and looking at the overall ranking, so again, of the 21 cities that were at the particular event at Harvard in October, this is how things fell out. And we'll talk a little bit more about what that kind of why some of these things maybe shook out the way they did. It's the overall entrepreneurial economic equity ranking, which is a lot of ways of saying that this is about the entrepreneurial disparities within these communities. In this case, if any of you ever ran cross country, you kind of take the score of the person as they come across the line, and the lowest score wins. Kind of same idea here. We looked at 10 different entrepreneurial equity measures, and then we basically ranked each city on those, right? So if your entrepreneurial equity was very small, which means that you had populations closer to each other in terms of equity, you scored better than those who had huge gaps. And so it's a very simple mathematical aspect. We just took these 10 levels, we ranked them against each other, and we just added up the scores of where they landed between 1 and 21. So, if somebody was first, they got a 1. If somebody was last, they got a 21. So in this case, again, like cross country, the lowest score is better than the highest score. Cleveland scored out of a possible 210, scored 147, right between Atlanta and Newark, and last place was Providence. And so that gives you some sense of where Cleveland landed in that context. And as I go through it, it'll show you a little bit more as to why. In terms of ranking this from a bar standpoint, as I said, a large part of this, so one aspect of what we look at is just the average, the gap that you have across these different populations. And when I say gap, what I mean is, like, when you look at using again the white community as the reference point, how big is the gap between the white community and the black community from an entrepreneurial equity point? How big is the gap between the white community and the Hispanic community? How big is the gap, et cetera, et cetera? Cleveland had the 6th highest average racial gap of all the organizations, and that just simply means that each of these populations, as we did the analysis on them from an entrepreneurship standpoint, who owns the businesses, what kind of revenue they have, et cetera, really we saw some significant gaps. And again, there's a report out there that you can look at. San Francisco had the best. I want to use this graph, even though it's a little bit busy, but I want to use it for a couple of reasons. It's something that we call city economic strength by race, which means that, okay, in terms of the racial population of each of these cities, kind of who has kind of the economic strength, right? Who has the power? And so again, understanding at the national level, that what we see is that, I mean, the green line, which represents the white population, I mean, this is a reflection of what we see at the national level, even though this is the 21 cities. The economic strength, which is the kind of vertical axis that we're dealing with, it shows kind of where each population sits, and these are, again, the 21 cities. Now, Cleveland, I made the dots a bit bigger, so the red dot, the yellow, the blue, the purple, green. And I will kind of point out a few things from here, and then again, we'll talk a little bit more, because I think you're going to find something interesting about this. So if you look at the green line, the white population, you see that Cleveland's white population economic strength is pretty relative to other folks around them. Looks like Newark probably has their white population has a higher strength than Cleveland does. And that just means kind of where they land in the economic ecosystem. If we look at looking at American Indians, the blue line, it's kind of consistent across the board. I mean, all the populations, and part of that is a matter of there's just such a small population of American Indians, and we'll talk more about how population matters in a moment. If you look at the red line, which is the black community, you see Cleveland's black community is pretty low in terms of economic strength relative to some of the other folks. Now, you're right beside Atlanta. You look at Memphis, Newark, and New Orleans, you see kind of a parallel in terms of level, and I talk more about that momentarily. First, I want to point to the yellow line, which is the Hispanic line, and you see that, you know, kind of Cleveland actually is doing a little bit better from a Hispanic standpoint than some of its counterparts like El Paso, Fort Worth, Houston, and you know, Long Beach and things of that nature. So here's the interesting thing about this kind of data aspect. The bigger the minority population in a community, often the more inequitable it is, the bigger the challenge. And so I want to kind of hold that up, because people can say, wait, Atlanta, what do you mean Atlanta? How in the world is San Francisco's Black population doing better than Atlanta Black population? Because everybody thinks of Atlanta as being this kind of mecca. And in some ways it is, but I will explain momentarily kind of why that is. I just wanted to kind of sit that down for a moment to say that there is a correlation between these places that have these large minority populations. So for example, if you look at Atlanta, Cleveland, Memphis, New Orleans, they all have large African-American populations, and those are places that African-Americans are the most you know, economically strained from an entrepreneurship standpoint. If you look at the yellow line, El Paso, Fort Worth, you know, Houston, some of those places have large Hispanic populations, and that's where Hispanics tend to do the worst. And so that's just something to think about, and it also kind of ties into the strategy that you have to think about when you're moving forth. Kind of as we kind of move toward, you know, kind of the Q&A piece, I wanted to kind of go back to this idea of this equity curve, right? So I showed you earlier on the United States curve, and so it's represented here by that yellow line. You know, that's the same curve I showed you earlier for the U.S. and on this relative index. And again, just a reminder, the relative index it means that simply if one goes up, somebody else has to go down. If one goes down, somebody else has to go up. What this slide actually shows is that on average, Cleveland is more inequitable than the United States as a whole. So when we aggregate all the data in the United States and we get this inequity curve, Cleveland is more inequitable on average than that. Again, the purple line here is equity, is flat. In a perfect world, you know, we would just see a flat line, but we don't. So the way you interpret this is that, you know, I've kind of accentuated the Cleveland line, the red line, and basically what it shows is that the reason why it's more inequitable on average than the United States is that the whites in Cleveland are quite a bit higher up in terms of their economic strength than on average in the United States. Blacks in Cleveland are a lot, you know, further down in terms of their negative strength than blacks in the United States. American Indians, Asian Americans, Hispanics are all below that. Now, this is something that's interesting. Again, I do these charts all across the United States and these different cities. Most charts follow the American kind of line. I mean, you see it has the same shape. So, I mean, to a certain extent, it does follow that. But most cities actually follow this kind of pattern of whites being above the lines, blacks and Hispanics being below the line, American Indians being kind of on the line, and Asians being slightly above the line. The interesting about Cleveland is that, you know, it's one of the ones that where every minority in Cleveland from an entrepreneurial economic equity standpoint is below the line. So nobody actually gets the equity in Cleveland from a minority standpoint, which is why the white population sits so high on that relative index. And so I did find that to be pretty interesting in looking at this particular graph. Kind of finally, moving toward the end, going back to these ideas of this gap, and I won't kind of belabor this particular chart, but I highlighted the blue and the red because the blue is when you average up all the gaps in the United States, you get kind of an average of almost 116% between whites and minorities. So that's kind of the gap between the white entrepreneur and business community and their minority counterparts. When you do that in Cleveland, you get 258 as the average gap. And so you see kind of a broader gap, average gap in Cleveland than the United States. And don't worry about, I know there's maybe some scale issues here, but in terms of, you know, kind of the way it looks, but what I want to do in the little box up in the top corner where that yellow kind of highlighted is to show kind of what is the racial equity gap from an entrepreneurship standpoint amongst these populations, whites, blacks, whites, American Indians, et cetera, et cetera. In the U.S., you see 139 for white to black. So the biggest gap in the United States is actually between whites and Hispanics at 140, almost 146 percentage points between those two. Now, when you look over at the Cleveland gaps, basically what it says is that the gap between whites and blacks in Cleveland from an entrepreneurship standpoint is 2.4 times bigger than it is on average in U.S. It's 2.5 times the white American Indian gap, 2.5 times white Asian gap. The Hispanic gap is only 1.7% higher in Cleveland than in U.S. But when you average all that together, it's basically saying that the inequity amongst these populations of races is more than twice as inequitable in Cleveland as it is in the United States. And so it gives you some context of kind of, where you land from that standpoint. And so, going back to kind of how we do this and how we measure this, I wanted to kind of give you a breakdown of what it looks like. And in this case, it's not as simple as saying that the green is good and the red is bad, because it depends on what column we're in. And so I want to try to give you, again, the information in a rapid form, but hopefully it can make some sense for you. So if you look at that, the racial breakdown and overall population of Cleveland is roughly 35% white, 49% black. You look at Hispanics, about 11%, 2% Asians, and under 1% American Indians. So the next 4 columns after that are really a overall measure of, in some ways, successes around firms, right? So that first column looks at, well, of those populations, kind of what percentage of the firms of all firms in Cleveland, right? Firms that are sole proprietorships or have paid employees, how much of that share does each of these populations have? So the 34.5% of the whites have, 50.6% of all firms in Cleveland. The 49.1% of the blacks have 40% of all firms in Cleveland, et cetera, et cetera. In terms of the green, means that they're overrepresented, right? Which means that, whites should have 34.5 to be equitable, but they have 50.63, which means they're overrepresented. Blacks should have 49% of the firms, but they only have 40% of the firms, which means they're underrepresented. So that's what the red and the green represent. If you look to the next category, now this is where we deaggregate this, right? We say, okay, well, let's look at just the firms that have paid employees, which again are the ones that capture most of the revenue. Those 34.5% of the white population in Cleveland control almost 88% of those firms, whereas the 49% of the blacks control less than 5% of those firms that have paid employees, and the 11% of the Hispanics own only 1.6% of the firms. Asians actually continue to overrepresent, right? They are 2% of the population, but they actually have almost 6% of the firms that have paid employees. And so that gives you some context. When we move over to the next category, this is about, of those firms, who's capturing revenue. And then again, you see that the 34% of the white population that's in the folks that are in Cleveland actually control, they capture 92% of the actual revenue that comes to businesses. If you move over 1, when it looks at businesses with paid employees, they can control about 94% of that. And so that's where those columns, they're overrepresented, underrepresented. The 49% of the black, the black population in Cleveland, of the overall business revenue, they only control 3% of the total business revenue and 2% of the business revenue of firms with paid employees. And so you start to see where some of that discrepancy comes in. When we look at the last column, the overall poverty, and the connection between overall poverty and these other categories is this. What we know from data and from research is that firms, minority firms, or any firm really for that standpoint, owners of firms tend to hire people from their own network. So when minorities start firms and they start hiring people, they tend to hire people that are from their network. So women hire more women in their firms when they start businesses than men would otherwise do. When minorities open firms, they grow firms, they hire more minorities. African Americans hire more African Americans, things like that. So the relationship between that and this is that there should be a correlation between the growth of firms, particularly those with paid employees, and the actual poverty rate of a particular community. And so in that category, the overall poverty, you actually want to be underrepresented, right? Because it's better if you have less poverty than your population is accounted for, which is why, there's 34% of the population in Cleveland is white, but only 26% of that population is in poverty. And so you go, and so, blacks actually, one of the interesting things about Cleveland is blacks actually are underrepresented in poverty as well, which is not normal for most places. Most places, blacks, just like Hispanics, are overrepresented. In this case, American Indians, Asians, and Hispanics are all overrepresented in poverty. based on their population, you see Hispanics are about 3 times overrepresented. Asians are about 14 times. I mean, so that gets you to a point of why your overall ranking is so challenged from that standpoint. And so the final slide is that we're talking about from a Cleveland standpoint looks at this. And so this is on a scale of, this goes from -400 to 400, again, with 0 being the kind of equitable aspect. If we were to say, and I think about this kind of from a basic standpoint, imagine your bank account, right? In Cleveland, the white population would have about $195 in their bank account. Every other population would owe money, be in debt to the bank. They'll be overdrawn per se. Blacks the worst by at about -140, Hispanics -55, American Indians -40, Asian Americans -19. And again, one of the interesting things about this is Asians tend to usually do better in places, but again, something's uniquely going on in Cleveland that's kind of impacting all the racial groups. And so that gives you kind of a quick snapshot. I know it's not a rosy snapshot, but a quick snapshot of Cleveland. So now I want to wrap up and give some context in the post-COVID America and Cleveland. Again, we know that COVID really just accentuated the issues that we knew were already out there. And now, some folks are shining a light on it, but we already knew that it was going to be there. The data I just showed you was pre-COVID. And so, the expectation and the understanding is that currently in COVID and post-COVID is just going to exacerbate those. Okay, now I'm on mute. Sorry, I got muted. Well, anyway, so kind of lastly, going through this, what we know about recessions and minority entrepreneurship is that it's kind of a double-edged sword, which means this: when recessions hit, people lose their job. I mean, that's the definition of a recession. And so essentially, what's going to happen is that a lot of folks are going to go into the marketplace. Once jobs come back, some folks may be able to find jobs and some folks won't, and those folks that aren't are going to sometimes try entrepreneurship. If you look at the 1930 data, that's essentially the Great Depression. And so the Great Recession, which is 2008, is it wasn't as bad as the Great Depression. I feel like the pandemic that we're in now is going to be closer to the Great Depression numbers. And so there's an expectation that there's going to be a lot of entrepreneurship that comes out of that. But the issue is that, usually it's unfairly distributed, meaning that it's kind of like the last hired, the first fired usually are minorities. And so they tend to overrepresent in terms of being displaced from work. And then once jobs reopen, they don't have as much luck as getting back into the marketplace. And so they start businesses. But per my earlier comment, they actually don't end up creating businesses that add employees. They end up creating a lot of sole proprietorships. And so that creates a problem as it relates to this idea of that these wealth gaps and things like that. And so we can expect to happen as a function of this is that there's going to be a lot more entrepreneurs that come on board as we come out of COVID-19. And again, there's going to be a lot of minorities because they're the ones who tend to get displaced mostly. And so I wanted to use that for some context to offer kind of some parting words about Cleveland. See, for some reason it's not letting me see if I can I got one more slide. Oh, here we go. So my last slide talks about, so what are some key takeaways for Cleveland? And so the COVID-19 impacts are going to be this. Cleveland can expect to see an increase in Black and brown entrepreneurs, African Americans, Hispanics, because there's going to also be white entrepreneurs increase as well, but you're probably going to see a disproportionate number of Black and brown entrepreneurs because they're the ones that are going to be displaced more often. In terms of, you can see an increase in entrepreneurial racial inequity. So those lines I showed you that in terms of where they stand, they're going to probably become more inequitable. Now, they may all shift down, which means that whites may be economically hit just like every other population, but the chances are that the gaps are going to expand and they're going to be bigger in Cleveland than they were before COVID-19. There's going to be a decrease in overall levels of business with paid employees. I'm sure if you like everywhere else, every day you're hearing owners saying that, well, I'm not going to be able to open up when this is all said and done. But you're probably going to see a disproportion of those firms be Black firms. And so again, just like we saw in the earlier data, you're going to see more African-American firms disappear from the ecosystem than other firms. And then kind of finally, the other impact is that you're going to see a decrease in minority wealth. So that road to zero wealth that we talked about is going to happen by 2053 or 2073 if something doesn't change. It's probably going to accelerate, or not, it will accelerate to a much faster kind of area. And so we have to figure out what do we do in order to try to change that trajectory. Kind of just 4 quick recommendations I would give, and these are, again, I mean, we could spend a whole day talking about these, multiple days. I generally talk about these kind of 4 areas that every city should focus on when they think about kind of adjusting their entrepreneurial ecosystem and the gaps. One is increasing the pipeline of these underrepresented minority entrepreneurs. One is place and space. How do you position these businesses in communities so they're not just totally segregated in the poorest parts of the community, and you actually put them in places that they can succeed? Access to capital is always a huge issue. And then removing barriers. You know, what are those barriers that keeping these businesses from being successful that are, you know, maybe imposed superficially? And so 4 specific recommendations to think about. And these, again, these are broad, so you have to come up with very specific strategies under them. Increase the number of underrepresented minority businesses that have paid employees. Again, that's an important aspect. If you ever want to get to the point where you are seeing wealth created, seeing people hired from the community, seeing you know, some level of equity, you have to increase the number of Black and brown businesses that have paid employees in that context. Second, you got to increase the sustained risk capital. And I use that as a very appropriate, I should have highlighted risk capital, because all capital is not created equal. Again, some capital is like, well, you know, a lot of times with minority businesses, it's like, well, here's a debt fund, take out this debt. And so you get a lot of kind of different kinds of capital. But as soon as you take out debt, you have to actually pay it back. So you need more capital, you need larger amounts of capital that can go to these businesses so that they can actually grow and sustain, and it needs to be risk capital, so equity. Third, you need to look at your city and county budgets and see how you're spending that money. This goes to the point of why you have those negative numbers around entrepreneurial leverage. Black and brown communities pay into tax bases, but the way that money comes back out of the tax base oftentimes is, you know, is different. White communities get wealth enhancing investments. Black communities often get investments that tie you further to the social sector. And so you need to look at the Cleveland data and the municipal budget and really understand how that money is going in and how it's coming out. And then finally, you got to increase the number of kids that are getting introduced to these innovative environments earlier in their career. And that will help on this pipeline. It will help create, you know, things that are based on intellectual property, and that will help over time to turn the ship around. So there's short-term and long-term strategies that can be focused on. And so, you know, sorry, I know I went on, but that's what I have for you guys. And so thank you very much.
We thank you very much. This series kickoff is about what does it all mean, and you did a great job on each of those slides, helping us understand the data. And I love the fact that you ended with some recommendations and some thoughts about COVID-19, which is clearly is a huge factor that's going to accelerate the economic inequity. So I'm going to jump right into the questions that we have. The first one is from Dominic Matthew. Is there a concerted effort on the national level to collect racial data? There was a huge debate on the COVID positive cases being collected by race because African-American populations were being affected disproportionately.
I think that's one of those issues that keeps coming up, is that, you know, in terms of the racial data. So I say for the answers, a quick answer right now is no, in terms of concerted effort. I know that there are some local areas that are trying to maybe better collect that data. In reference to kind of researchers and things like that, I say a lot of researchers are trying to push for that, but, you know, this data comes from the local level, and if local level is not actually reporting the data based on these demographics, then it's very hard to aggregate that at the national level. So we get data, you know, sometimes now on men and women, so we do see that data, We see some data around race, but not in a significant way. So that's something that a lot of folks are trying to push for.
Great. Thanks. I'll just keep going. And you touched on this when you mentioned risk capital. I saw this question come up early on from Shabani, one of my colleagues. It says, how do things like private equity investment impact this data? Does this data include minority ownership by Black and brown people?
Yeah, so this data, the data that I utilize data from the U.S. government. So it's census data, and basically there's for those who've kind of been around this, there's something called a survey of business owners, and so basically the IRS data that anybody that on their taxes identifies themselves to a Schedule C or LLC or something like that that has earned at least $1,000 or reported $1,000 of earning on their taxes gets captured into this. Into the database, and so it utilizes that as it relates to looking at the actual share of the ownership in it, and then it uses that data also as it relates to, that data, the survey of business owners captures revenue data, the number of employees, kind of employee-owned firms, all those kind of things. So it captures every industry from that standpoint. It also certainly, from a tangential aspect, recognizes the impact that the lack of private capital and private equity and things like that coming into this ecosystem, the impact it actually has on the numbers that we see, and the lack of businesses being able to grow from sole proprietorships to firms with paid employees. And the other thing I want to say about that is that when I talk about risk capital and the need for that, because all capital is not created equal, and part of the challenge is when we think about what we try to do on local levels is that essentially what drove the overall, let's say the white entrepreneurial ecosystem to a certain height has been kind of federal responses as well, right? So we've had, with central banks and how, Fed Reserve and how capital gets to the market and things of that nature, even now in the midst of COVID, right? So immediately when we started shutting down, there was a response that, okay, let's create, first it was 1 trillion, then it ended up being 2 trillion, and that money was then circulated through these traditional institutions, and the same discriminatory kind of outcomes that you've seen historically representing themselves in that first round of the PPP. And so I say that to say that, even as we think about local kind of strategies and things like that, we can't disconnect it from these kind of aggregate things at the federal level, kind of Silicon Valley per se, and work how capital gets into companies.
Thanks. Next question is from Keisha Gonzalez. How does this calculate the informal economy as it pertains to the Latinx population? There is a volume of Latinx enterprises that hire undocumented employees, those who operate in cash, mainly due to lack of trust of the colonized. Notions of banking and credit depend on lending circle structures for capital. How does this data capture that? And I would say that would be similar in some other communities as well, but particularly towards Latinx communities.
Yeah, so I say, so that's a great question, and thanks for the question. So in a lot of ways, this data doesn't fully capture that. And I say, here in North Carolina, for example, I do a lot of work with Hispanic economic development, and we have something called a Latino credit union, and we work closely, and we recognize that their entrepreneur network and things like that are often captured because, again, because this data is driven by IRS data and pulled from that standpoint, it doesn't fully capture that. I think there are other studies that do a pretty good job of estimating both kind of this off the books kind of economy, as well as its overall economic impact on the overall economy. One of my colleagues at Keenan Flagler Business School at UNC Chapel Hill, Jim Johnson, released a report a couple of years ago about the economic impact of the Hispanic population on North Carolina, which in those kind of analyses, you capture some of that informal economy. I'd say the data that we talked about here really focuses on the formal economy. But I think it's still relevant in the sense that whenever you're dealing with the informal economy, You certainly have a lot of ecosystems that are getting more robust with the lending circles and the kind of the cash hiring and things of that nature. But it still in some ways removes you from some of the bigger resources that it would take to really scale, right? And so if you're not filing taxes, or if you're informally hiring folks or things of that nature, you're not going to be able to walk into a bank and take out a loan for that. A perfect example is the PPP program, right? I've seen a lot of data, or at least heard a lot of anecdotal kind of pieces around who's able to get access to that PPP. And so you got a whole formal economy, and you got populations of that can't get access to the PPP. But the kind of the conversation has been around it. There's a whole lot of these informal entrepreneurs and firms that just have no ability at all to even access it, because they're in their formal economy. And so I would say that that may be a gap in terms of how we do this aggregate entrepreneur ecosystem reflection to do a better job of capturing some of that informal data. But there are some data sets out there that tries to estimate that. This one just doesn't.
Thank you, and great question. Through the lens of the data that shines the light on the truth, have you and your partner began to see best practices for improving the curve? And that's from Kevin Johnson. And Kevin also is the chair of our Council on Smaller Enterprises.
Great question, Kevin. And it kind of dovetails off your question, Brian, earlier about strategies and things of that nature. Again, I would say on the aggregate, no. And let me put it like this. So, when I go into a city and somebody wants me to kind of give them some thoughts about where they are, and like I said, I generally try to go in and hold up a mirror as the first thing I do. I also try to that last question, I try to speak the truth, right? Because there's always a historical narrative to how you got to this point, right? There's a broader aggregate one on a national level, but then there's also one at a local level. And so you can go to communities all across the United States, and you can understand, hey, well, this used to be this, and then they ran a highway through the middle of it, right? Or this used to be this, and then they did this. And so it's always important to go to these communities and actually speak the truth, because that you need a level of trust at these kind of local levels. But I mention that because when I go into these places and I sit down with the mayors, or I sit down with the the budget officers or whoever else, the chiefs of staff, and they say, oh, Henry, can you give me one or two things that we should be doing to really make a dent in this issue, right? And I preface whatever my comments is by saying this: it wasn't one or two things that got us to this point, right? And so it's not going to be one or two things that get us out of this. In some ways it's like 1,000 paper cuts, but then, it's like 1,000 machete cuts in some of these ways. And so I mentioned that to say that, to answer Kevin's question, I don't see places that have done it on an aggregate level. Again, I see places that have tried, they try one thing or two things, and a lot of times they do it because they say, oh, well, we need some kind of proof of concept, so let's try this one thing. We can't try 10 things, let's try this one thing and see how it works. But the truth is that the reason why we see these huge disparities that we see is because it's a complex mix of all these things that's happening in the overall economy. And if you don't figure out a way to address multiple levels at one time, multiple levers at one time, you're just not going to have some of the outcomes you want. If you're going to do, folks that want to do one thing at a time, it's just not going to get you to where you want to get to. So you have to think more comprehensively. You got to be more strategic. You got to be more innovative. You got to be more bold, actually, what it comes down to.
Thanks. That made me smile. Next question is from Chris Carpenter, and this ties, I think, to your double-edged sword slide. Is there historical data that can indicate the percentage projection of the overall decrease in businesses with paid employees post-COVID-19? 10% less, 15% less, question mark.
So there's a lot of folks now, including myself, who are trying to figure out that model, right? And because this is so unique. So, what I do have is I look at the past kind of the overall economy, right? So looking at, times of market growth and time of recessions, right? And looking at the data. And the good thing about it is that the data that the government captures from census data actually follows pretty well with the recessions, right? So, whether you're talking about the early 1990s, or you talk about, the dot-com bust, or you talk about the housing crisis. I mean, the data, interesting data that the government captures every 5 years or so actually follows pretty well along that. And so I say this, this really is a unique crisis, right? I mean, it's a totally unique crisis in the sense that, unlike every other crisis, I mean, you can make the argument about the 1918 pandemic, but, there's not a lot of that was really focused around the health aspects, not so much the economic aspects. And so it's hard to find a parallel to where we are now, because we have a combination of both, right? So this is an economic crisis that is driven by a health crisis. And until we get the health crisis under control, we have issues with this whole kind of where the economy going. I mean, we're in that midst of that fight right now, right? With who's reopening, how you reopening, all these kind of things. And that's again a whole nother conversation. But so to answer your question, it's hard to really model very well kind of where we will be. I'm trying to put together some models now on the curve to see kind of how I think the curve will shift. But to answer your question, I think it's going to be dramatic though, because if I can take data from traditional recessions and say, well, this is the kind of impact that we see during traditional recessions, and it hits like this, it's going to be kind of trying to figure out what is the multiplier for this versus that, those past recessions. And at this point, there's some white papers that's come out, things like that, and I don't think we've been able to really fully capture what that's going to be yet, probably because we're still in the midst of it.
Thanks. We've got about 5 more minutes, so I want to keep moving through these questions. This one is from Tony Peoples, one of our colleagues and volunteers in our Minority Business Growth Committee, actually. Tony said, would you expand on the wealth enhancing versus social tethering and give examples of cities that are being intentional about the wealth enhancing initiatives or funding?
Thank you for that question, Tony, because actually when I was going through the slides, I was feeling bad because I knew I was running over my time out, but that is actually a very, very important kind of part of the analysis, right? So let me just use, let me start at home, right? So I'm in Durham, North Carolina, and Durham is one of the more politically liberal, like one of the bluest cities in the country in terms of just how it votes from that standpoint. So kind of I started seeing this pattern as I was looking at these inequities across these different cities, and I started to say, well, okay, well, how do we better understand this? Because everywhere I go, as I said, these cities would be like, yeah, we're doing the best. Nobody's better than us. We're all about equity and inclusion and da 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 da. But then, when I do the measurements, I'm like, okay, well, you're actually getting worse than you were before. So what's going on? And their response would be, well, we don't understand. We're getting worse despite, the kind of investment we're making, all these things we're doing, right? And when I looked at the data, I started pulling these data on like the city budgets over the last decade, the county budget over the last decade, and what I started finding was a pattern. And so before I tell you what that pattern was, I would say the punchline of this is that these cities who say that we're seeing inequities despite all the things that we're doing, I would argue back that actually you're seeing inequities growing inequities because of things that you do, right? And so what I found, what this wealth enhancing investment versus social tethering, this is essentially what it means. I just use kind of real examples to help you kind of get your mind around it. So let's say you have a downtown area, right? And some developer comes in and they say, I want to build a hotel. And usually this gets broken down into white versus black and brown communities, right? So I will racialize it in this sense just to kind of make the point. A white developer comes into town and say, oh, well, there's an old building that's been there. It used to be a bank building. Let's turn it into a hotel. And the white developer they raise some money from investors. They say, well, hey, look, city, I got this money from investors. At the current way that the pro forma looks, I'm only be able to return about 15% return to my investors, but they want 20%. I need the city to come in and put some resources, build me a parking deck, give me some kind of tax rebate, do something that allows, workforce grant, do something that allows me to get my return up to 20%, right? So the cities kind of hem and ho, and they say, okay, we'll do it. Now, if a black person try to come or Hispanic try to come and open a hotel, you get, usually, at least in my experience, you get a much different response. It's like, oh, you don't really need a hotel. You don't know anything about a hotel. And so the wealth enhancing is that you take kind of a population that already has wealth, you take folks that bring in capital to the table and say, okay, well, we're going to invest more and we're going to just enhance your wealth. In terms of the social tethering, say you got that same city and there's a part of the city and say, oh, we want to do some revitalization of the city. They look into a black and brown neighborhood and say, oh, well, there's an old school over there that's been sitting empty for a while. Let's turn it into a health center, or let's turn it into a community center. Again, there's nothing wrong with community centers, so I don't want to usually leave the call thinking I'm saying that there's something wrong with community centers, things like that. But what ends up happening is that investment becomes, oh, well, let's create a community center. I always say you can create a space where we can sit around and talk about how poor we are, right? And so the challenge is that, you know, one type of investment, that developer with the hotel, that's a wealth enhancing in the white ecosystem. The one in the black and brown community is one that kind of just further takes you to the social fabric. And so what you see, or what I've seen at least in the cities I've gone around and looked around, is that you've seen a lot of that kind of racial dichotomy in the communities, even without them even fully recognizing it, right? I mean, and I'm not taking anybody off the hook. I'm just saying that a lot of times it becomes just kind of naturalized. The last thing I say about that is that, you know, what I found is that there seems to be some correlation between the politically liberal aspect of the communities in these places and the inequities, and without going into too much of detail, I would say it like this: what you tend to happen is you sometimes I find you have a lot more inequities in some of these communities. Some of that is again because you have these large populations of minorities, but then the additional that is that the response to those populations tend to be more paternalistic in these communities than otherwise. So it becomes more like, well, hey, we know what you really need, and you don't need that hotel that you partially own. You need the community center, and so we're going to get a community center because that's really what you need, regardless of what you're telling me. And so there's a lot that goes into unpacking again why we see these inequities as we do.
Well, that was great. Thanks for the question, Tony, and thanks for that answer. I think we could have spent an hour just on that particular topic. We've got one last question, then we're going to wrap up. This is from Jasmine Dixon, who's terrific collaborator and coordinator of our business growth collaborative effort. She says, is there any data on this subject specific to the re-entry environment?
So thanks for that question, Jasmine. That's actually a very important question in all this, because if you're going to understand these inequities and how you close inequities, you really have to understand the makeup of the population that you find exists, right? The unemployed, the what they would call disconnected youth, that don't have jobs or college degrees or high school degrees, things like that. And the formerly incarcerated is incredibly important. I'd say kind of like this, similar to the question about the informal economy. I would say that there's probably not anything that de-aggregates it on a massive scale from that standpoint. I'd say that any formerly incarcerated person who hangs out a shingle as a sole proprietor or starts a business that grows, and I've seen some of those, they get pulled into the data set through IRS data, so it would be hard to disaggregate that. Having said that, I do think it's important because more and more we're having to figure out kind of how do we work with those who have been just as involved as some folks like to call it. In Durham, we actually started a program with the city called Welcome Home, where when someone gets out of jail and they're coming back to Durham, they get a bus pass, they get some money, they get they help them find a place to live. And actually, we have a pilot now where some of them are getting jobs with the city, where we pay. The city pays for up to 6 months of employment and then help place them. But I mention that because as part of that program, we have something called Inmates for Entrepreneurs and some other things like from inmates to entrepreneurs and some things like that we're working on. So Jasmine, it's an important question. I say that I don't feel comfortable that we have the data kind of at a real level yet to understand what this looks like, but it certainly is an important piece of this puzzle as we try to work to close these gaps.
Thank you. We are right at 1:14, and so I'm going to wrap us up here. First, I want to thank you, Henry, for the time you spent really delving into what does it all mean. This is something we're going to do a lot of. I appreciate also your offer for us to not just stay in touch, but to partner, because the real effort that you want and we want and those on this call want is to see those gaps reduce and change, and that's what we're working towards. And you talked about in the beginning, the national data and things that we already knew pre-COVID that are starting to show themselves. I likened it to when you play hide and seek with your kids. You know, you close your eyes and you open your eyes, you can see your kid right there hiding behind the curtain. You know where they are, but you pretend you don't see them and walk around the room to make them feel better, and then act surprised when you finally see it. And I think, you know, this data, this truth, as Kevin Johnson said, is something we at GCP's Equity and Inclusion are trying to amplify the voice of, but not just for the sake of a loud voice, to turn that into action. And you could hear that from some of the questions. So thank you so much. Thank all of you for attending. Look forward to our next session. We've already got another research, this one a local one, lined up to talk about some additional data relative to entrepreneurship. Henry, I look forward to seeing you soon.
Thank you for the opportunity. Great talking to you all. Be safe.